Hello. I am honored that you've taken the time out of your busy schedules to allow us to address the CFPB Integrated Mortgage Disclosure Rule that goes into place in 2015 and will frankly change the way we close residential transactions forever. Welcome. I'm Ann Anastasi, Director of Agency and Lender Education for Old Republic National Title, and today we'll take just a few minutes to talk about a rule that is a whole lot more than a simple form change. It took the CFPB, the Consumer Financial Protection Bureau, 1,888 pages to complete a task put upon them by the Dodd-Frank Act, which was to take the 4 disclosures consumers receive prior to financing a residential property. Those 4 disclosures, the early till, the GFE, the late till, and the HUD-1 settlement statement. They were directed, the CFPB was directed through Dodd-Frank to take those 4 disclosures, get rid of them all, and create one combined integrated mortgage disclosure form. This new form and all of the rules that go along with it, which are massive, affect almost all of the closed-end mortgages that we deal with today in residential purchases and refinances, with the exception of those you see in front of you: reverse mortgages, home equity lines of credit, commercial loans. They will not fall under the scope of this new rule, but almost every other closed-end mortgage does. And don't sit back when I tell you that the implementation date of this new rule is with all mortgage applications received on August 1st of 2015 or thereafter. I say don't sit back because we have so many things to put into place, so many new processes to understand and to perfect, that we need to get started now. And we also have to understand that there is great liability in making certain that we follow the rule to the letter. The Dodd-Frank Act gave the power to the CFPB to enforce these rules, all of their rules, and to level penalties. And if you look at the bottom bullet point on this screen, violations of this rule carry stiff penalties. $5,000 per day per violation if you just make a mistake, all the way down to, or up to, $1 million per day per violation for knowingly violating this rule. At implementation, the lenders, soon to be called creditors, will only have 3 days from application to issue the first half of the mortgage disclosure form, called the loan estimate, or the LE. They'll only have 3 days to issue that. The rule specifically says that lenders, creditors, may rely on the real estate professionals to help them gather the information about the fees that will be charged at the time of closing. They may call you, the lender, creditor, may call you for assistance with calculating transfer taxes, home warranties, what kind of seller credits will there be at the time of closing, are there any personal property purchases that will occur at the time of closing. The lenders are up against a very strict time limit, and my point of talking to you about this today is whether they're calling you, the real estate professional, or the title industry, we need to respond immediately. This is a process we can put in place today, the sense of urgency when a lender calls seeking help, because their time frame is so shortened. Another thing that we have to recognize is that after we've given information to the lender at the time of loan application, when they issue the loan estimate, from that period to the time of closing, things change. And it's imperative that we have steps in place within your offices and within the title industry offices, that if anything changes that will cause a change of fee or an additional fee at the time of closing, we need to call the lender, creditor immediately. Let's put process in place that will trigger that phone call. The lender needs to protect themselves against these changes because the lender is liable for certain items when it comes to tolerance levels. We're all used to tolerance levels today. They are getting beefed up under the new rule. And it's important that we become partners with the creditor, with the lender. Give them a call immediately upon learning of a change. Whether you think it's a tolerance level change or not, give them a call. Let the lender decide whether or not they have to revise their loan estimate. We talk about all of these things because of the way closings are going to change. The more the lender knows about in the beginning, the smoother the transaction will go at the time of closing. And here it is, the portion of the rule that will have the most effect on the way we close and if we close. The lenders must complete the closing disclosure. That which is similar to the HUD-1 today must complete the closing disclosure and have it delivered to the consumer 3 business days prior to closing, or we do not close. Period. We do not close. It's imperative that the title industry as well as the real estate industry have all of their numbers presented to whoever it is who is preparing or inputting those numbers, and I'll talk about that in a minute, well in advance of closing. Gone are the days of bringing invoices to closing. Gone are the days of using the closing table as a negotiating table. We must have all of our numbers into the creditor or into the title company well in advance of the closing date. But I know that we can do this. We can easily get our numbers well in advance so that we can provide them to whoever is doing the inputting and delivery of the closing disclosure so that they can meet the delivery requirements, because the definition of delivery within the rule is very strict. If we hand deliver the closing disclosure to the consumer on a Monday, we may close after the 3-day review period, which ends on Thursday. However, if we put the closing disclosure in the U.S. mail, there is an assumption that it will take 3 days to get to the consumer. Then the 3-day review period begins. So now we're talking 6 days in advance. If the deliverer of the closing disclosure chooses to email, there is an assumption in the rule that it takes 3 days for the consumer to open their email. So we're still talking 6 days in advance. There is a provision within the rule that allows the 3-day review period to start earlier via email delivery if, 1, the consumer signed an authorization to receive disclosures via email in advance, and 2, if the deliverer has proof that the consumer who is supposed to receive the disclosure actually received the disclosure. Otherwise, we are still talking 6 days in advance. The closing disclosure can be overnighted to the consumer, but there must be proof that the consumer, not the 17-year-old son who's home from high school, received the closing disclosure via the overnight delivery. So the thought is that we need to move and gather our information much earlier in the transaction. If a closing company or the title agent or a law firm is permitted to do the inputting, then they're going to need all of the numbers, all of your invoices, all of your charges at least 7 days in advance so that they can input the numbers, get them to the lender for approval so that 6 days in advance the closing disclosure may be delivered, because we do not close unless the consumer has their 3-day review period. Why not start putting this practice into place today? We just need to move our timeline up in the transaction. I think it's better that we start now getting used to the gathering of the information earlier in the transaction rather than at the last minute. Invoices brought to the closing table will not stop closing depending on what the invoices are, but they certainly may delay the closing. And let's talk about the preparation and delivery of the closing disclosure. Up until now, the custom has been that the attorney agent, the closing company, or the escrow company prepare the HUD-1. but many of the lenders across the country, particularly the major lenders, have decided that they will take on the responsibility or the function of inputting the numbers onto the closing disclosure. Almost all lenders will want to deliver the closing disclosure. That means to all of us that we must get our numbers and our invoices and our calculations done in advance to communicate those to the lender so that they can prepare the closing disclosure, deliver it on time, and we can close on time. If the lender allows the closing company or the attorney agent or the escrow company to do the inputting, it still means that you need to gather your information well in advance. The lender will retain all of the liability and the responsibility for following the section of the rule, but our communication and cooperation will help the consumers and us get through closing on time. And here is a simple chart put together by the American Land Title Association that shows what needs to be done and when. The top section, the red section, shows what day the closing is scheduled. The blue section shows when the disclosures are due. The yellow section shows when the disclosure must be mailed or emailed. If you look at a closing on a Friday, or your desired date of closing is a Friday, the preceding Tuesday, the consumer must receive the disclosure, the closing disclosure. So therefore, the preceding Friday, a week in advance, the lender or the closing company, whoever is delivering, must mail or email the final closing disclosure. This does not mean, however, that we cannot accommodate changes that may occur during those 3 days prior to closing after the consumer has already received the closing disclosure. In many parts of the country, pre-settlement inspections are conducted the morning of closing. And let's say, as an example, the mover has, no disrespect to the movers, has damaged a wall. Then we need to talk about, at the time of closing at the table, if it is a table closing, what credits will go between seller and buyer. If, however, the change affects the APR to cause it to become inaccurate, or if the loan product changes in those last 3 days, or if a prepayment penalty is added, closing stops. A new disclosure, a new closing disclosure is created, it is delivered, and there is a new 3-day waiting period. But it's only if one of these three or some of these three items occur: inaccurate APR, change of loan product, prepayment penalty added. Otherwise, changes can be made. However, if the lender creditor has decided that they will be doing the inputting of those numbers, you know where I'm going with this, that $40 change at the table because of the damaged wall will have to be called into that lender. That lender will then have to prepare a new closing disclosure. We don't have a new 3-day waiting period, but we have to wait until the lender transfers or transmits that revised closing disclosure back to us. I worry very much about the delays of closing if the lender is going to prepare or input the numbers into the closing disclosure. We have to be prepared. The more the lender knows prior to the 3-day requirement, the smoother our closings will go. And what about the poor seller? The seller receives a copy of their closing disclosure not in advance, but at the time of closing. And you may see this occur. You may see your settlement provider make the decision that they will bifurcate, separate the closing disclosure form, one for the borrower, one for the seller. The new rule allows for such a bifurcation, and I am hearing across the country that that may be the route that the closing industry will go in some areas. Let me quickly walk you through the closing disclosure itself. Any of you that have reviewed or explained the HUD-1 settlement statement will not have difficulty understanding the new form. Let me walk you through the buyer side and the seller side, and then just quickly show you a seller-only closing disclosure. The first page of the closing disclosure shows the most important information that a borrower wants to see. Right on the first page, it shows the loan amount, the interest rate, the monthly payment. It goes on to talk about principal and interest payments and escrow payments and if there's a PMI, and then it shows what the borrower is going to need to close the transaction. Take a look at page 2 of the new closing disclosure form. Doesn't it look familiar? Doesn't it look like page 2 of the HUD-1 settlement statement? There are some changes. There are a couple of extra columns. You will see that line numbers, as we know them, have been removed and we are now into categories. You'll see that each of the categories totals upwards. And something fun to throw in, anytime we add a fee to a category, we have to put it there in alphabetical order. You will see your fees, your commissions, and any reimbursements to your organization down in category H. The form is simple to understand, particularly if you've worked with the HUD-1 settlement statement all of these years. Page 3 of the combined closing disclosure form looks very similar to what we're used to, with one exception. The top 1/3 of the form itself explains to the consumer what has changed from the time of the loan estimate to the time of closing, talking about tolerance levels, etc. But look at the bottom 2/3 of page 3 of the closing disclosure. It's very similar to page 1 of the current HUD-1 settlement statement. Again, line numbers have changed, but the categories remain the same that we're used to now with the HUD-1 settlement statement. Explaining this to your consumer, understanding this, if in fact that's a role you take in your state and are allowed to take that role, this will not be a great leap from what you're used to today. And here is an example of the form that has been separated to the seller's side only. I think many of the people in our industry, in the title industry, will go this route. We are particularly concerned with the privacy issue of non-public personal information that is shown on the combined form. So maybe we will go this route, maybe your settlement provider will go this route. And I just wanted to show you what it looks like. It's very straightforward, very easy to understand. This is page 1, and here is page 2. Very simple to understand, very easy to explain to your seller. As we've talked about today, this is much more than just a form change. What are the things that we can do now? We can create systems of communication that will trigger a phone call or a communique to our lender, our escrow company, our title company, whenever there is a change or whenever there are additional fees. We absolutely can create a system today that reminds us to deliver all invoices at least 7 days prior to closing. We need to talk to our buyers to impress upon them the importance of responding immediately to any lender, escrow company, title company requests. And we need to talk to our staffs about the same thing. We don't want to be the ones that, because we didn't communicate, we had to cancel the closing. So it's important that we are joined at the hip, that we communicate well with all of the parties in the transaction so that the consumer experience at the time of closing is one that occurs on time and that goes smoothly. I now want to take just a moment to say thank you for allowing us to be with you today. Please know that if you have any questions, Ask your Old Republic agent, and if they don't know the answer, because none of us know all of the answers on this new rule yet, they will get the answer for you and bring it back to you in a timely manner. This new rule is much more than a new form. It's a change in the way of life. And I know that we can all accomplish this. We should get started now. Thank you again.